They called me crazy when I said I wanted a 20% plus yield from my portfolio, and they said it couldn't be done. They said it was too risky. Here I am sitting on a six-figure portfolio that should pay me over $45,000 every single year in pure passive income. Welcome to Psycho Investor channel, and today we are diving into something that separates the real psycho investors from the gamblers. Position sizing. Just kind reminder, if you don't like my Eastern European accent, just mute the video, turn on the subtitles, and collect that valuable information. You see me posting these crazy yields all time, but today I'm going to show you exactly how I structure my portfolio to generate these insane returns while keeping my sanity intact. This isn't about gambling, it's about engineering income streams. Let me show you something that's going to blow your mind. Right here is my actual portfolio, and these numbers tell a story that most investors never understand. Everyone sees the crazy yields I speak about, the 190% from Kony, the 85% from MicroStrategy, the 76% from Koi. But what they don't see is the careful position sizing that makes these yields possible without blowing up my account. Let's start with what I call our foundation, the backbone of this entire operation. ProShares Bitcoin Strategy ETF, ticker BITA, makes about 30% of our portfolio. You can't buy it from Europe without professional investor status, but you can buy BITA KZ instead via Kazakhstan. This is our highest conviction play, generating a 54.71% yield. Now, I know what you are thinking. That's still a huge position in a volatile asset. And you're right. But BITA isn't just about yield. We're up about 23% on capital appreciation, and more importantly, it gives us exposure to Bitcoin through a regulated ETF structure. This is a strategic position that we've built up over time, watching its behavior across multiple market cycles. The yield is amazing, but it's the overall risk-adjusted return that makes this our largest position. Next up in our foundation is QYLD, taking up about 20% of our portfolio. This is our stability play, consistently generating around 10 to 12% yield through its covered call strategy on the Nasdaq 100 index. When tech stocks go crazy, QYLD keeps collecting premiums. When market tank, QYLD keeps paying us. This is what I call our sleep well at night position. Completing our foundation is Main Street Capital at around 13% of our portfolio, and with only 4.17% yield, some of you might be wondering why a psycho investor would allocate so much to such a low yield. But here is the genius. Main isn't just about yield. We're up over 30% on capital appreciation, and it provides exposure to private credit markets that move differently from our other positions. Now these three foundation positions makes up over 62% of our portfolio value. They're our anchors, our stability providers. But look at what comes next. Let's talk about our maximum yield plays. Kony is yielding at insane 119%. MST is 85.56, Koi pushing 76.89, and TSLE is delivering around 70%. These are the kinds of yields that make traditional investors lose their minds. I also have other positions, and you can take a look at my whole portfolio in this video. But here is the key. Together, all of these high-octane positions make up less than 8% of our total portfolio value. So this is where true portfolio engineering comes into play. By limiting our highest yield positions to 1–2%, we're able to capture these incredible yields while maintaining portfolio stability. Any single position blows up, and let's be real, with yields this high, it's always a possibility, our maximum portfolio impact is minimal. The beauty of this structure becomes clear when we look out at our income streams. Our foundation positions, despite being lower yield, actually generate about half of our total portfolio income. That's our baseline, reliable, consistent income that hits our account every month. Our enhanced yield positions, those in the 20–50% range, contribute another 30–35% of our portfolio. And those psycho yield plays, they are the turbo boost, adding our final 15–20% of the portfolio that takes our income to the next level. This creates a fascinating income pattern. Every single month, we've got distributions flowing in from multiple positions. When markets are calm, we are collecting. When markets are volatile, we are collecting even more. It's like having multiple income streams that actually benefit from market chaos. Now, let me show you exactly how I implement this strategy. When I'm looking at a new position, the first thing I look is not the yield. It's where this position fits in our structure. For our foundation positions, we are ready to allocate up to around 20% of our portfolio if the risk-reward makes sense. For our enhanced yield plays, we cap initial positions at around 5%, and for those maximum yield opportunities, never more than 2% to start. But position sizing isn't just about initial allocation. We are consistently monitoring and rebalancing based on market conditions. When beta runs up, we might trim a bit or just not reinvest our distributions into beta again. When our high-yield positions get volatile, we adjust by buying more. This isn't a set-and-forget portfolio. This is active risk management. One of the most powerful aspects of this structure is how our positions interact with each other. Beta moves with crypto markets. QYLD follows the tech sector volatility, May in response to private credit conditions. This diversification across market drivers is what allows us to maintain such aggressive yields while managing overall portfolio risk. Let's talk about volatility management. By structuring our portfolio this way, we are able to maintain a reasonable portfolio beta while still generating yields that most investors think are impossible. Our maximum drawdown protection is built right into the position sizing, and our income stability is secured by our foundation positions. Look, I know it's tempting to go all in on those 100% plus yield positions. Trust me, I get it. The math looks amazing. Take $1 million, get $1 million in annual income. But that's not how successful investing works. What I'm showing you today is how to build a portfolio that can deliver exceptional yields year after year, cycle after cycle. The results speak for themselves. Our portfolio is generating substantial yield while maintaining structural integrity. We are not afraid of risk, we are just sizing it properly. This is how you build generational wealth while still being able to sleep at night. That's the position sizing in the Psycho way. If you want to learn more about how I structure these positions and manage risk, smash that subscribe button and hit the bell. Drop a comment below with your position sizing strategies. I want to hear how other Psycho investors are managing their portfolios. See you in the next videos.